this is why I'm buying Nike going into 2026. Let's hop right in. So, this is Nike stock. Everyone knows Nike. It's the check mark. Everyone knows their shoes, products. I'm sure everyone knows what a Nike tech is, stuff like that. But this stock is down 50% in 5 years. So you're like, why would I be buying a stock that's down 50% in 5 years? And honestly, it should be down 50% in 5 years. You look at the revenue, it's declined. It's up 1% in 1 year. That's nothing. That's lower than inflation. Revenue is basically declining. Net income, also declining. You can see free cash flow, also declining. EBITDA, also declining. EPS, also declining. The cash is basically flat. The only two metrics that look good on this company is dividends and shares outstanding declining. Even you can see the common stock repurchase is not very much for what I would like to see. So you're like, Carson, are we looking at the same company? Like, there's no way I can justify buying this. But in finance, you got to ask yourself, always ask yourself the why. So why is this company doing so bad, right? It all starts with this guy right here. This guy's name is John Donahoe, right? This is the Nike's old CEO, right? This was before Elliot Hill. He took over in 2020. You can look at his LinkedIn here. His LinkedIn, he started out at Bain & Company, which is a consulting firm that he worked for 20 years. Okay, consulting, that's not going to help in the shoe business. We worked at eBay. It's also not related to clothing, all right? We worked at, we were the CEO of ServiceNow, also not gonna help you in clothing. He's basically a consulting guy. He's like worked for SaaS companies, always trying to drive margins, margin expansion. He's not from like a Nike. He doesn't understand Nike's business, which isn't against him. I mean, I wouldn't understand Nike's business model completely well either. I mean, I'm just not qualified. I don't think he was qualified to take over this business. And he had this game plan, right? He was gonna go direct to consumer. This was his first step of his game plan, all right? Direct to consumer, right? He was going to pull himself out of retailers to go to direct consumer because everybody is going to buy it off the Nike website instead of buying it because it has good shelf space at Foot Locker. Unfortunately, that's not how that works. Nike was getting like 75 to 80% of their sales from like Foot Locker, even after this app was in place. So it's like they were just losing customers, you know. So they got rid of all of their shelf space. That's why you see the rise of like Hoka or all these other shoe brands. They're rising. Like even Adidas has been taking market share and stuff because of him pulling them out, them losing that valuable shelf space. You know how important shelf space is. Like if you go to Target, you literally have to spend millions of dollars to get a specific spot in Target. You know, it's the same thing for like Dick's, Foot Locker, and they were willing to give it to Nike because they had a lot of money, they're driving a lot of business. But at the end of the day, Dick's and Foot Locker, they need to hit their margins. They need to hit their sales quota. They need to pay their rent. They need to sell shoes, you know? So if Nike's not going to provide them what they need, they're going to have to go somewhere else. And that's where Hoka comes in, those other running shoes. You know, if you can't get Nike running shoes, you're going to have to go somewhere else. So that was terrible for their business. Next step, he was going to basically remove innovation. And you're like, why would he remove innovation? He's like, because R&D was just another expense. They're just shoes. They're just like shoes in a brand. They don't have to have this newest technology. You don't need to spend $2 billion plus on R&D. That's going to hurt your margins. You can cut that expense, increase your net margins, and that's going to be good. Because once again, he's from that side of the business. He's from the consulting world. He's just focused on margins. That's all he was focused on was margins. He didn't understand Nike's brand, you know? Like inventory management. This was another thing he just completely neglected. Because if you look at the inventory levels in 2022, it's peaked to all-time highs, you know, from all the excess inventory where they're overbuying from COVID. Because they had a COVID boom with the stimulus check and stuff. So they were booming, so they stacked up all this inventory. But once the inventory was stacked, they never sold it off. Then they were just stuck with a bunch of inventory. You can see it massive increases. I mean, they decreased it slightly, but like we need to go back to the 6.5 level, maybe 7 because they were growing, like had higher revenues and stuff, but revenue was pretty much flat, you saw. So really, I would want to see it in like the 6.5 to 7 range, and it's still elevated all the way up at 8 billion. So, you know, that's not very good. It's a lot of tennis shoes that are going to be forced, which are like, okay, why does it matter if they have excess inventory? That's not even that big of a deal. That's what I was thinking. I was like, I mean, I wouldn't think that would affect margins that much, but it does if you look at this. So, brand dilution from a constant promotions, right? Nike's a premium brand, right? So, consumers are expecting a premium quality product. So, you're going to get rid of R&D, and on top of that, you're going to be forced to discount this excess inventory because, I mean, what are you going to do with it? It can't just all sit there. You don't have enough warehouses. So, you have excess inventory, which leads to discounting. Discounting, which eventually hurts your brand, which causes a weaker brand. So on top of that, now Nike's stuck with the weaker brand. If you have a weaker brand, you're not going to be able to go through as many products, which is going to cause a slower sell-off, which a slower sell-through equals more discounting. So it's just kind of a loop. You don't want to be in this loop, and Nike got put in this loop. It's part of the reason. I mean, look at their fundamentals. It's terrible. Those fundamentals are awful. You can see this. They had net margins were trending up to about 12%. But then as we continue to lose this because of tariffs, inventory buildup, so as we were getting forced to discount, we were not being able to charge high quality dollar because of all the lack of R&D and the innovation that we were getting rid of. So initially, what margins got boosted, it all just went away. So it did nothing. So long term, it's just going to kill the company. You can see this 1.8% number, which you're like, that's because Elliot Hill is being forced to sell off all this inventory at a massive discount, just trying to get rid of it. Plus the tariffs. It's just and a weak consumer, so they don't have as much pricing power right now. It's just all around a rough situation. Brings in this guy right here. This guy's name is Elliot Hill. This is the guy I was referring to earlier. This is a veteran of Nike who's been there for 32 years. He's been at Nike since 1988. We can go ahead and look at this. This is his experience, right? He started in the sports world as an athletic trainer. So he's already been in the sports world since he was literally a little boy, basically. And he's worked at Nike for 17 years and 15 years, 32 years, right? And he ended up getting so high up, he was basically like the number one man at Jordan. And you saw how successful Jordan was. It was growing year after year and year. And that's hugely thanks to him. Like, he worked right next to Phil Knight. He was basically his right-hand man to an extent. And he was in charge of an entire branch, one of their biggest branches. Because really, if you know Nike, they have Converse, Jordan, and athletic shoes. So, running shoes. This is a lot of their revenue. So, right, okay. So he basically has to come in and fix all these mistakes. So he basically has this win now strategy, right? So first step of this win now strategy is focusing on athletes. He's done great at this. These are some of the big signings they have. Caitlin Clark, you can look at here. They signed an 8-year deal, $28 million, getting a signature shoe, signature logo, really strengthening the bond of the WNBA too. She sells out massive stadiums and stuff. She's a huge celebrity. And I think a lot of girls are going to be wanting to get these Caitlin Clark shoes when they come out. So I think this will be a massive moneymaker. You have Kate Cunningham, who's doing really good in the NBA right now. I'm not the hugest NBA guy, so I don't know necessarily what he's doing, but I know he's been really good, and he's basically getting his own shoe. This is a 6-year deal. So this was supposed to be released in 2026. And then they also just signed this huge deal with LSU, which signed 10 of their largest athletes and is basically completely getting a great partnership between LSU and Nike. So they have the 10 people, and you're like, okay, it's basically doing this thing. It's a Nike Blue Ribbon Elite program, which is basically a start of a program that's going to be signing more colleges. So basically, they're going to try to go up to these colleges, sign the top 10 athletes, and make them Nike endorsed athletes. And I think this will be really, really, really good for Nike long term, because a lot of people watch college football, college sports, because it's all the sports. You had cheerleaders in there, gymnasts, football, baseball, basketball, every sport that you can consider, they're signing people from. So you have and then they just signed this deal with Kim K. This is Nike Skims. This is basically like a sports line for girls, so the bras, and other sports attire. There's shoes in there, a little bit of everything. So they're doing a great job with partnerships. This is also the first ever partnership Nike signed, so that's pretty interesting. Next thing they're doing is getting back into retailers. So right now they signed a deal with Amazon. They've signed a deal with Dick's Sporting Goods, Foot Locker. They signed a deal with Macy's, and basically all these big retailers that where they were pulled out of and losing shelf space, that they're now having to catch up and trying to get the shelf space back. So we'll see. I think they're going to be able to get a decent amount back, and even if they can't get the shelf space initially, they should be able to outbid like Hoka. And if they can't outbid Hoka, they'll at least hurt Hoka's business, because Hoka's going to have to do discounting to comprehend the new Nike products that are going into these retailers. So, and I mean, once again, Dick's doesn't really care whose product they're selling, as long as it's selling and they're getting their margins they want. So, if Nike is giving them more products and more inventory, I mean, they're going to go with Nike. It's just how that works. So, Nike, and then also, this is the most underrated thing that I feel like a lot of people don't even think about. AI is going to help Nike so much. A lot of people don't even think about that. These are like AI, you're thinking, okay, NVIDIA, Broadcom, but they're not thinking of the businesses that are actually going to be able to use AI. And this is a big emphasis for Elliot Hill. And he's actually going to use Nike, because think about it. If you're able to predict how much inventory you need, what inventory is selling the most, the speed of the inventory, and how much like wholesale you need to have, it's going to make you a really, really strong competitor. So this is a big emphasis for him, and I think this will save Nike so much money in the long term. Because, I mean, you don't need to have all these analysts projecting inventory, and also the waste on inventory is going to go so much lower because it's AI powered. So this was something the not even thought about before, but this actually is going to be a huge beneficial of Nike, and I'm super excited to see how they use AI in the future. But they're investing, I think they have over $2 billion R&D expense. A lot of that's going to shoes, but I guarantee at least like 20 or 30% of it's going to AI. So, and then on top of this, Nike is going to be getting benefited by the Federal Reserve. The Federal Reserve just announced they're buying $40 billion of T-bills, which a lot of people are like, what? $40 billion? A lot of people didn't even hear this. They cut rates, but they don't even understand what this would do. This $40 billion in Treasury is going to lower T-bills, because the more demand for T-bills, the lower the yield on T-bills go. Lower the yield on T-bills, the more that this is going to go down. So, and that's not even talked about. And then look at all this money in money market funds. We're sitting at almost $7.5 billion in money market funds. The lower the interest rate goes, they're going to be more willing to buy Nike. I mean, if you can get a Nike stock, right, you're getting a 2 to 3% yield, and you can get a money market fund that you're getting a 2 to 3% yield, you're going to choose Nike because you get that extra growth, you know? So, I mean, if you're looking for income, Nike's going to be a great pick as they continue to lower yields. Because, I mean, if you're getting 5% in money market, you're not going to go for the 2% on Nike because you're getting that 3% extra yield. But on top of that, he's also doing some massive restructuring here, which I could read you this, but I think the most important part is from all this is right here. The 4 geographies are now directly reporting to Elliot Hill, right? So instead of having all these middlemen, he's getting rid of all the middlemen. He's having one person of each region, the head of each region, and they're all directly going to report to him. If your region's failing, it's that one specific person's fault. You know, you have a China team, a Europe team, a Middle East team, and an American team. And if they're failing their specific region, that could be the issue, is that head person that's in charge of that region. So there's going to be a lot more isolated, a lot more responsibility on that one person, and responsibility equals results normally. So this is super, super bullish in my opinion. So what am I personally doing, right? You can look here. This is what I did last week. Last week I bought $941 in stocks, and 5 of those were shares of Nike. 5 shares of Nike I bought. I bought some Celsius and cake. But the focus of this video is not going to be cake or Celsius today. So we're going to go through my discounted model on Nike, right? So $1.95 EPS is their trailing 12 months, which is pretty respectable. I mean, they're actually getting hit really bad by tariffs. Honestly, if tariffs go away, this could easily bump to $2.50 right away. But just for off the tariffs going away, and then once these discounting inventory stops, which will probably be Q2 or Q3 next year, we could see EPS easily 20+%, which, I mean, even analysts are projecting 20+%. They're expecting a mid, 2026, even possibly negative growth. I personally don't think it'll be negative growth, but And then I think an EPS multiple on a Nike is going to be like 25. I think that's very, very like respectable for a clothing company with like very predictable cash flows. I think a 25. Like normally, like historically traded a 30 plus. So I think a 25 is super, super, super realistic. So this is giving me a 12.43% return. And honestly, this is my base case. If we go to like my bull case and do a 25%, that's going to be a 17% annual return. So, I mean, the bear case, if I had to do a bear case, would probably be like 10% EPS growth and like a 20 multiple. So I lose a little bit of money if that's the case. But I don't think this is going to happen. I think this turnaround story is going to happen. And that is why I own a good amount of Nike. We can go here. This is my current Nike position, right? My current Nike position right here. This is one of my portfolios. I got 4.42 shares of this beast in here. And then on this portfolio, this is my main portfolio. It makes up about 5% of the account. I own 38 shares. So I have about 42 shares of Nike. And if you want to look at that relative to my total portfolio, here's the Carson Fund, which is my main taxable account. My biggest position right now is cash. But if you look down here, is Nike at 4.51%. It's still a relatively small position, but I plan on building this out early Q1 2026, or possibly I might buy some more next week. But I think it's a great, great upside, and I think a lot of people don't understand the narrative with this stock. So I'm happily buying some more next week, most likely. So that's basically going to be it for this one. So I hope you enjoyed, and I hope you learned a little bit about Nike and why this turnaround play is a lot more likely than a lot of people want to believe.